Ladies and gentlemen, Economic Asian Guy here. We are standing at the most schizophrenic moment in silver market history. On one side, we have the most bullish analyst predictions in decades. UBS targeting $5,400 gold and proportional silver moves to $150. Kevin Thompson from 9i Capital saying silver needs to hit $170, $200 to match inflation-adjusted highs. Peter Schiff declaring that 2026 is when it gets real for precious metals. These aren't fringe YouTubers or conspiracy theorists. These are major bank analysts and respected economists calling for triple-digit silver within months. On the other side, we have the most bearish technical setup since the 2011 crash. Starting next Thursday, January 9th, index funds managing the Bloomberg Commodities Index will be forced to sell $5 billion worth of silver futures. That's 13% of the entire COMEX open interest dumped into the market over 5 trading days. Not because they want to sell, not because the fundamentals have changed, not because China reversed their export ban, but because silver's weight in their index has grown too large due to price appreciation. They're algorithmically required to sell the winner and buy the losers. Think about the insanity of this timing. China just locked down 60% of global silver supply 3 days ago. Industrial panic is spreading across Western supply chains. Physical premiums in Shanghai are hitting $20 over paper prices. And Wall Street's response is to engineer a $5 billion artificial sell-off because their computer models say silver's allocation is too high. This is the ultimate battle between intelligence and algorithms, between human analysis and computer rebalancing, between market reality and mathematical formulas. The analysts see $150 silver because they understand supply and demand. The index funds will create $72 silver because they follow rules written by people who think commodities are just numbers in a spreadsheet. Welcome to the most predictable market manipulation in history, and the most profitable opportunity for anyone who understands the difference between forced selling and fundamental value. Let's start with why the smartest money on Wall Street is calling for triple-digit silver, because these predictions aren't based on hopium or technical analysis. They're based on mathematical necessity. UBS analyst Giovanni Stonovo just told Reuters that gold is on track to hit $5,000 per troy ounce in 2026. If gold hits $5,000, and the historic gold-to-silver ratio normalizes to 30.1, silver hits $167 per ounce. If the ratio compresses to the 16.1 ratio that existed for most of human monetary history, silver hits $312 per ounce. Kevin Thompson from 9i Capital put it perfectly: silver still lags significantly, needing to move into the $170–$200 per ounce range to match its inflation-adjusted highs from 1980. That's not speculation. That's math. When silver hit $50 in 1980, the dollar had significantly more purchasing power. In today's debased dollars, that $50 peak equals $170–$200. Thompson continued, gold has now broken through its prior inflation-adjusted highs, while silver still lags significantly. This means silver has fundamental catch-up potential that gold doesn't. Gold is expensive relative to history. Silver is still cheap relative to history. Peter Schiff, who predicted the 2008 financial crisis and the current precious metals rally, just declared that 2026 is when it gets real for gold and silver. He's not talking about modest price appreciation. He's talking about monetary crisis. He's talking about currency collapse. He's talking about the moment when the world realizes that paper promises can't compete with physical elements. But the most compelling case for $150 silver comes from the supply-demand fundamentals that have been building for years. According to the Silver Institute, global silver demand hit 1.24 billion ounces in 2025, while mine production was only 1.01 billion ounces. That's a 230 million ounce deficit. But those numbers were calculated before China's export restrictions. Now, with 60% of global refined silver locked behind Chinese licensing requirements, the Western world faces a 400 million ounce shortage. There's no inventory to fill that gap. COMEX registered silver is down 70% since 2020. LBMA vaults have lost 40% of their holdings. Shanghai inventories are at decade lows. The visible above-ground silver supply is disappearing while industrial demand accelerates. When supply shrinks and demand grows, prices don't go up linearly. They go up exponentially, especially for commodities with no substitutes. And that exponential move, according to multiple analyst projections, targets the $150–$200 range. Now let's discuss the $5 billion algorithmic bomb that's about to explode in silver's face, because this is the most cynical example of financial engineering versus market reality in modern history. The Bloomberg Commodities Index is rebalanced annually based on a formula that considers production values and trading liquidity. Silver's weight in the index was set at under 4% for 2026. But silver's price appreciation in 2025 has pushed its actual weight to over 9% of the index. This creates what Wall Street calls a rebalancing requirement. Index funds that track the Bloomberg Commodities Index are contractually obligated to sell silver futures until their holdings match the target 4% weighting. The math is brutal. With silver representing 9% of a $60 billion index when it should represent 4%, that's $3 billion of excess exposure. But the selling pressure is amplified because the rebalancing happens through futures contracts, not physical silver. Each dollar of futures selling represents 10-15 Oz of notional silver exposure due to leverage. So $3 billion of fund rebalancing translates to $5 to $6 billion of futures selling pressure. Daniel Gali, senior commodity strategist at TD Securities, laid out the carnage. We expect a massive 13% of aggregate open interest in COMEX silver markets will be sold over the coming 2 weeks to result in a dramatic repricing lower. Think about that. 13% of all silver contracts on COMEX will be dumped into the market not because of bearish fundamentals, but because of mathematical formulas. The timing is perfectly Machiavellian. The rebalancing period runs from January 9th to January 13th. 5 trading days, the same week that Western companies are scrambling to replace their lost Chinese suppliers, the same week that industrial procurement teams are realizing their supply chains have evaporated, the same week that the physical shortage is becoming undeniable. And Wall Street's response is to engineer the largest algorithmic sell-off in COMEX history. This isn't market making. This isn't price discovery. This is financial terrorism disguised as portfolio management. The index funds don't care about supply and demand. They don't care about Chinese export restrictions. They don't care about industrial shortages. They care about tracking their benchmark. And their benchmark says silver is overweight, so they must sell. Period. No exceptions. No consideration for market conditions. No analysis of fundamental value. Just algorithmic selling pressure designed to force the price down to levels that justify the index weighting. This sets up the ultimate battle between algorithms and atoms because the $5 billion selling pressure is entirely artificial, while the buying pressure is entirely real. On the selling side, you have index funds dumping futures contracts because their computers tell them to. These funds don't want to sell. They're not bearish on silver. They're not responding to negative fundamentals. They're following mathematical formulas written by people who treat silver like a spreadsheet entry rather than a strategic element. The selling is price insensitive because it's non-discretionary. Index funds must hit their target weightings regardless of market conditions. If silver drops to $60 during the rebalancing, they keep selling. If it drops to $50, they keep selling. They'll sell into a vacuum if necessary because failure to track their benchmark violates their fiduciary duty to investors. This creates the potential for a feedback loop crash similar to what happened in 2011 when CME margin hikes forced leveraged longs to liquidate into a thin market. Except this time, the forced selling is coming from passive funds rather than speculative traders. On the buying side, you have Chinese industrial companies bidding $85 for physical silver, while American manufacturers scramble to replace their lost suppliers. These buyers are price sensitive upward, not downward. They need silver regardless of price because their factories shut down without it. When Apple needs 15 million ounces for iPhone production and their Chinese suppliers can't deliver, Apple doesn't wait for lower prices. They bid higher to secure alternative supply. When Tesla needs 2.3 million ounces for gigafactory production and their contracts are canceled, Tesla doesn't delay production hoping for a bargain. They pay whatever it takes to keep the assembly lines running. The fundamental buyers are competing for a shrinking pool of available Western silver, while the algorithmic sellers are dumping unlimited paper contracts. It's atoms versus algorithms, reality versus formulas, physical scarcity versus digital abundance. And this collision will determine whether silver crashes to $60 on forced selling or explodes to 100 plus on supply panic. The outcome depends on whether the algorithms can overwhelm physical demand or whether physical demand can absorb the algorithmic selling. History suggests that atoms always win in the end, but algorithms can create spectacular price dislocations in the short term. Looking ahead, next week's $5 billion liquidation represents either the greatest buying opportunity in silver history or the confirmation that financial engineering has permanently disconnected from physical reality. If you believe the analysts calling for $150 silver, next week's algorithmic crash is a gift. It's the last chance to buy silver at artificially suppressed prices before the physical shortage forces true price discovery. The forced selling will be concentrated and temporary. The index rebalancing ends on January 13th. After that, the selling pressure disappears while the physical shortage remains permanent. Chinese export restrictions aren't being reversed. Industrial demand isn't declining. Mine production isn't increasing. The fundamental case for higher silver prices strengthens every day, while the algorithmic selling pressure has a fixed termination date. Smart money will use the artificial weakness to accumulate positions before the physical premium reasserts itself. If you believe the algorithms, next week's selling pressure confirms that silver was overvalued and due for a correction. The index rebalancing is providing necessary liquidity to an overheated market. Prices will decline toward more sustainable levels that reflect industrial demand rather than speculative excess. But this view ignores the Chinese export restrictions. It ignores the industrial supply chain disruptions. It ignores the physical inventory depletion. It treats silver like a financial asset rather than an irreplaceable industrial input. The most likely scenario combines both narratives. Next week's algorithmic selling will create a sharp but temporary price decline. Silver might drop from $74 to $65 or even $60 as index funds dump their holdings into thin markets. The financial media will declare the rally over. The bears will claim vindication. The algorithms will achieve their rebalancing targets, but the physical shortage will remain. The Chinese export restrictions will remain. The industrial panic will intensify. And once the algorithmic selling ends, the fundamental buying pressure will reassert itself with exponential force. The companies that couldn't buy silver at $85 because their Chinese suppliers lost export licenses will pay $100 plus to secure Western alternatives. The index funds that sold at $65 during rebalancing will watch silver rocket toward the $150 targets predicted by major bank analysts. This is the ultimate test of whether Wall Street's mathematical models can overrule geological reality, whether computer algorithms can defeat atomic elements, whether financial engineering can substitute for mining engineering. The $150 prediction isn't based on hope, it's based on mathematics. The $5 billion liquidation next week isn't based on fundamentals, it's based on formulas. One represents the future, the other represents the past. The collision between them will determine whether you're buying the dip of a lifetime or catching a falling knife. But remember this, algorithms change. Supply and demand don't. Chinese export restrictions are permanent. Index fund rebalancing is temporary. Physical silver shortages are real. Computer models are abstractions. The analysts targeting $150 understand geology. The index funds selling $5 billion understand geometry. In the battle between rocks and spreadsheets, bet on the rocks. I'm Economic Asian Guy. Remember to think independently, trade carefully, and prepare for the most volatile week in silver market history. The predictions are triple digits. The selling is algorithmic. The outcome is mathematical. And the opportunity is once in a lifetime.